And thank you for attending today's webinar, Are We Heading Toward a Recession or Not? We are incredibly excited for this discussion and the guest that is joining us today. Less so for the potential conclusions, perhaps, but we'll get to that momentarily. Before we begin, a few procedural points. At the end of the session, we'll hold a Q&A if time allows. You can ask questions via the Q&A function to the right of your screen. Your questions will only be visible to you and the Flexport team. We may take some questions as they arise over the course of the discussion, but that's up to our discretion. We hope to get to as many questions as we can. Finally, we will share a copy of the slide deck at the end of the presentation. One more procedural point, and now to make the lawyers happy, please keep in mind that all information provided in this session is based on the situation at this current time and may not be customized to your specific business requirements. We always recommend reaching out to a Flexport expert to discuss your particular situation. And now, to introduce myself, I'm Christopher Clague. I'm a senior editor on the Flexport research team. And I'm joined today by Phil Levy. He is the chief economist and leads that research team. And we're excited to have with us Jason Furman, who is the Aetna Professor of Economic Policy at the Harvard Kennedy School. Jason was also the chairman of the Council of Economic Advisors during President Obama's second term. So thank you for joining us today, Jason. Very much appreciated.
Great to be here.
Thank you. So moving on, this is today's agenda. We're going to start off with a poll question in a moment, but before we get to that, 4 areas that we're going to focus on: GDP and consumption. And some of you may have seen the revisions to US GDP come out this morning. Jason and Phil will both talk about that. Next, the Fed employment and inflation, which I think has been at the top of everybody's mind of late. Modifying demand, so what are the external factors that are affecting the US economy? And then finally, maybe an answer to the question, are we heading for a recession? So we'll have 3 poll questions throughout the course of the event this morning. The first one is here. And how would you characterize the US economy right now? Strong, things are going well. A top-line reading of the revisions today might suggest that's the case. Steady, neither boom nor bust, but holding. I see a recession in the distance, and it worries me. And recession is already here. That would be a bold call. And I don't know. You tell me. So those are the options that we have, and they should be up on the screen momentarily. And it seems that this is trending towards, I see a recession in the distance, and it worries me. Although steady, neither boom or bust is a bit higher than we might have expected at 32, 33%, but we're almost at half for I see a recession in the distance. So thank you for answering the first poll question. So we're going to start with GDP and consumption, and I'm going to start with a question for Jason to take us through the BEA's revisions to US GDP that were released this morning. What do you see in those numbers, and what does it tell us about the strength or lack thereof in the US economy?
Great. Well, thanks so much for having me and starting out with the economy as a whole. A month ago, the government reported that in the first quarter of this year, the economy grew at a 1.1% annual rate. Today, it reported a revised number based on additional data that GDP growth in the first quarter was at a 1.3% annual rate. If that's all there was to the story, it would be quite simple. Unfortunately, it's actually much more complicated than what I just said, because the government today also reported another measure of how much the economy grew, and that measure said it actually shrank by 2.3%. That second measure is called gross domestic income, or GDI, and instead of adding up how much everyone bought in the economy, which is how you get GDP, it adds up all the incomes in the economy, which is how you get GDI. Now, in theory, GDP and GDI are 2 sides of double entry bookkeeping, they should grow at exactly the same rate. The only reason they're different is either that plus 1.3 in GDP is wrong, or the minus 2.3 in GDI is wrong, or maybe they're even both wrong. And so we actually literally don't know whether the economy expanded or contracted. We had the same discrepancy between these two measures in the fourth quarter of last year. And so if you look at an annual rate over the last 2 quarters, GDP is up 1.9% and GDI is down 2.8%. That discrepancy between the two is the largest we've ever seen for 2 quarters. This is extremely unusual to have these two measures moving in different directions. Now, I've actually done research on this in the past, and it turns out, what's the truth about how much the economy grew is usually about 50-50 between these two measures. And if you do 50-50, that says the economy actually contracted over the last 2 quarters and actually contracted in 4 of the last 5 quarters. This is a weird conclusion because jobs are being added at quite a healthy clip. Consumer spending seems to be up a lot, but there's just so much measurement data that I feel I cannot even give you a confident answer to over the last 2 quarters, did the economy grow or shrink, let alone what's going to happen over the next 2. I think on balance, probably the economy was growing, but growing very, very little and with a lot of fog around that, given the measurement error, unusually large measurement error in the government data right now.
Yeah. Bill, Jason mentioned consumption, and obviously this is something we spend a lot of time discussing and looking into. How do you see the consumption levels going forward? Jason mentioned they've been stronger than expected, perhaps. How do you see this unfolding over the next months, quarters?
Yeah, well, so we forecast this, of course, here at Flexport. I'm really intrigued by Jason's statement that this is the sort of foggiest our measures have been. And it's interesting to think about why. Here, what we've got up is just looking at key components of personal consumption expenditures. This is not the same as GDP, but it's a major component of GDP. Here, we're not doing. We sort of rebased everything so you can see what's happened since the pandemic. So this is part of my quest, and I'm going to ask Jason also why he thinks things are so foggy. But I think what you can see is, our instruments got knocked around quite a bit, that we had some really dramatic moves, and also dramatic in a way that wasn't really part of the norm. So looking at this graph, you've got 3 components to personal consumption expenditures. You've got services, then 2 components of goods. You've got durable goods, those are supposed to last for 3 years or more, and the non-durable goods, those have a shorter life expectancy. The point I would make, and I'll be interested in Jason's take on this, is only services here looks kind of normal in the sense of, it was a sharper than usual drop, the initial drop as the pandemic hit, but then you gradually recover and you sort of work your way back and it's all smooth. We've seen really odd behavior on the other 2. They do that initial drop, and then they boom to the point where we're having durable goods consumption up something like over 35% by the spring of 21. Where are we now? To actually answer the question you posed, what we're seeing in the numbers is that things actually look kind of steady to slightly up. So that would be my take. And that was on the previous graph. This is part of what had played into this real final purchase, which is supposed to be maybe a smoother measure. So maybe I can pose a question to Jason, which is, you talked about, I guess, your preferred measure of the whole thing as being this 50-50 blend of GDP and GDI. Where do you see consumption in this, or consumption measures? And does that give you pause about saying we're in a downturn?
Yeah, so the GDP versus GDI difference is just measurement error. One of them's right, one of them's wrong, or the truth is in between them. There's then a separate set of noise that's showing up in both of them, and that's inventories. And the behavior of inventories has been really volatile throughout the pandemic and post-pandemic era. In the first quarter of this year, inventories subtracted 2.1% from GDP growth. I think that's probably a temporary thing. I think we're unlikely to continue to see inventories subtracting at that pace going forward. And that's one reason to feel better about GDP growth going forward, that we're not going to see this type of big decline in inventories quarter after quarter. It's noisy and volatile. That's one reason why I think it's great to look at consumption. Consumption is a much, it's only 70% of GDP, but it's a less volatile, clearer 70% of GDP. I think the reason the economy didn't go into recession last year, despite the Fed raising rates so much, was the American consumer. They just continued to spend at an enormous pace. I attribute a lot of that to the lagged effects of fiscal stimulus. You give household, family of four got probably more than $10,000 in 2020 and 2021. They also cut back their spending in 2020, so they had even more excess saving from that. And that money really tided a lot of households through 2021, through 2022, even in the face of all this inflation and the like. They were able to maintain their spending. Now, if you look at household saving rates right now, they're quite low. And so I don't think this process that I just described can go on forever. Households will run through their excess saving. Their overall saving will be too low. We're seeing credit card balances and other credit rising. And so I'm worried about how long the consumer can keep going. But, up through the first quarter of this year, wow, American consumer was really impressive.
Yes, well, you've answered a question that's come in from the audience about debt rolling into GDP versus GDI and whether the consumer is overextended right now. Phil, I didn't mean to cut you off. I think you were going to weigh in there.
Yeah, no, I was going to pick up on that point, which is, so Jason, I think that's a good point, and I think the thing we've been fixated on is, how do you afford this? So first there was a sort of the behavioral thing of, didn't we think there was a sort of a certain amount of durable goods that people would want, and once you've bought, all the sofas to fit every room in your house, you just don't need sofas anymore, and that was part of the whole transitory reasoning. And then the other question is, presumably with the stimulus, there was an idea which was that you were going to have a handoff, that for a while there, the government was going to sort of resuscitate the economy, but then the economy would drive on its own. And we had seen a bit of a blip up in real disposable income. You don't see the economy sort of taking over on its own as a way to sort of drive that consumption engine?
Yeah, so let me take those questions in reverse order.
Yeah.
I like to think about sort of, if you didn't know about the pandemic, you didn't know about the policy response, where would we be compared to where you might have thought? So one way of doing that is looking at the Congressional Budget Office's forecast from January 2020. Other forecasts are similar. And consumption right now per capita is about 2% above where they thought it would be. And real incomes are about 2% below where they thought they would be. And so you have this real disconnect of surprisingly high consumption, even despite income. If you had asked me 6 months ago, I thought that gap could be bridged by the excess saving, but only for so much time. And so consumption would have to slow down quite a lot to bring those closer together. I'm a little bit more optimistic about consumption right now for exactly the reason you said, that household income growth in the last 6-9 months has actually been pretty good. Jobs are being gained quite a lot. Hours have stabilized. Headline inflation has come down. I think core is a problem. We can come back and talk more about that later. And so I think there is more ability for households to sustain this consumption, but still not enough to maintain it at these levels. So I think there's going to need to be an adjustment in consumption at some point. It just may not be a huge one, and it certainly doesn't need to happen in the next 3 or 4 months. In terms of what the durables are that these households are buying, I have no idea how they're continuing to buy at this level. I would have thought everyone had enough patio furniture and exercise equipment and didn't need to keep buying more, and yet they do. That level, as you can see in your chart, remains really quite high.
I wanted to sort of touch on the inventory point that you raised. First, because inventories are hard to understand in these numbers. It's sort of what is the change in inventories or the change in inventories, and so maybe getting some helping sense of that. The other point that I wanted to, I'll venture a hypothesis here, and I wanted to see what you thought of it, which is we had a lot of discussion during the pandemic about whether there was going to be a fundamentally different approach to inventory, which was, were we going to go from just in time to just in case? And, if you asked why we had gone in the other direction originally, it's because just in case, as in keep a lot of inventory around relative to sales, is expensive. And so people said, look, we can streamline, we can cut our costs by keeping tighter levels of inventory. We have this shock where it gets a lot harder to move things. Just in time depended on this ability to move goods quickly as you got sort of changes in demand. Could you meet those? If you say, well, people bulked up on inventories and then are going back to just in time to save costs, would that explain some of what we're seeing in the numbers, where you say, okay, if I wanted to keep, for a while there, I wanted to keep, 120 days of inventory on hand. Now I'm going to go back and I want to keep, 60 days of inventory. Would that be consistent with the kind of stuff that we're seeing in the GDP numbers as sort of an adjustment, which looks like a slowdown, but maybe isn't so much?
Yeah, I think I've asked a number of businesses that question just to try to understand it better and to understand how they were thinking about it. And I've certainly heard some say this was a scarring experience. We want to keep more inventories going forward. And in fact, we haven't even gotten up to our desired inventory level. And I've heard others say, yeah, we temporarily accumulated some, but we now know the world's gone back to normal. And so we don't. So I don't quite know which of those two effects is larger. What you saw in the pandemic originally was inventories plummeted, and cars, they basically went down to almost 0.0. It's a slight exaggeration, but only a slight exaggeration. And now they've been rebuilt. You're basically on the same inventory sales trend you were on prior to the pandemic. So it sort of looks about normal, judging from where you were before. But in terms of where it is compared to what businesses want now, I'm much less sure about that. I tend to think, we're going to see some more rebuilding of inventories, at least in the next quarter or two, and there's more room for that. And that'll be adding to GDP, and one of the things that sort of helps it from being negative and keeping us out of recession. But I'm not at all sure about that, in part because I feel different businesses are making different types of decisions about this right now.
Okay, thank you for that, Jason. Phil, any last points on that before we move on to the Fed?
No, I think we've primed ourselves for an inflation.
Okay, well, moving on then. So we're going to come up upon poll question 2 here. So by the end of this year, the Fed funds rate will be right where it is now, 20 to 50 basis points higher and holding, heading back down, or ever onward and upward. Will be a very interesting discussion in this. The Chairman Powell had some comments on this last week, but we'll see what Phil and Jason have to say as these poll results come in. And yes, sorry, go ahead.
As we wait for the poll results, Jason, what do you think markets have priced in? We'll see whether the markets agree with our audience.
Yeah, markets expect a 25 basis point cut by the end of this year, one cut.
And then when do you think markets expect that the Fed reverses itself?
They think the first cut will come in, will basically come sort of more like November. They keep pushing that date out. They had been expecting it earlier, but recently, that first cut, yes, is November.
Okay, well, the poll results are in, and our audience thinks option B, 25 to 50 basis points higher and holding by the end of the year. So differing from the market. So Phil, we also watch the Fed and inflation and interest rates very closely. What's your take on this? Do you agree with our audience?
Yeah, I would go. I actually would put myself right there with 25 to 50 basis points. And no, the way I assume our audience, being the wise, perceptive people they are, took the question seriously, which is by the end of this year. So that's saying sort of more up and not the sort of turnaround that, as Jason described, is priced in. I think that's right. And I think to see why it's right, we have to get to the topic that Jason foreshadowed earlier, which is what's going on with inflation. And I think the first thing, and I'll put this out there and be very glad to hear what Jason has to say, but the first thing in Fed watching is, remember, and they will remind you regularly, they have a mandate. Their mandate is price stability and full employment. And that's what they're going for. And then you have to see, well, okay, those big drivers of Fed policy, where are they? So I think if we go to the next slide, we'll hopefully have some useful data on this. So here are some measures of inflation. Actually, in this, we bring in our European friends as well to show. And I think this also shows well what I think Jason was hinting at, which is the blue numbers here are US, the green numbers here are Europe, and then you see there's solid lines and there's dotted lines. The solid lines are the headline numbers, and the dotted lines are core numbers, one way or the other. And so the story that I think this tells about our experience is, first, it's useful to know when all this stuff started. We were before looking at like demand surges and those demand surges peaked in about the spring of 21. Well, what you see here is up until spring of 21, things look pretty tame in these major inflation measures that we really, we don't highlight it as much in this graph, but certainly in the US, 2% is what you should look at as a reference point. But the Fed has kind of made clear this is what we're aiming at, roughly 2% inflation. And if you're looking at this in, February or March of 21, you say, yeah, that's pretty much where we were. In fact, we kind of had some things dip below that. So it's nice that we're kind of getting back to where we're supposed to be. And then you saw things take off. If you're looking at the headline numbers, and I'm going to focus on the blue here on the US, we can talk about Europe a little bit later. But you focus on the headline numbers, it got really intense. We got to about 9% CPI inflation, but then things have gotten dramatically better. You drop from 9 to about 5, and so it looks like you're well on your way back to 2, and so maybe the Fed's work is near done because things are improving so much. I would argue that's not what we should be looking at. It's the one that gets all the attention. There's a reason they call it the headline number. But the core number is a lot more troubling. And I think this is what plays into answering that poll question, which is that you see that this it takes a little bit longer to get going up. Note that it doesn't launch the same way. By the way, I should say a word. The difference between core and headline is that there's all inflation measures are take a bundle of goods or services, average them out and see what's happening to prices. Some of those prices are really volatile. Even if they have the same sort of broad trend, they jump up and down a lot more, notoriously food and energy prices. So the core numbers are supposed to take out those volatile numbers and just look at the steadier component. And so it's supposed to be a bit more reliable that way, not get buffeted around as much. And what you see is, for the US, it takes a little longer to get started. It's really not heading up that much until summer to early fall of 21. And then it sort of moves on up. It's flattened out of late for about the last year, just under the last year, but it's flattened out and steadied somewhere just above, say, 4.5%. It does not look like it's trending down. It doesn't look like we're almost there. And I think that's probably the Fed's concern, which is that what they need to see is that dotted blue line sort of unmistakably moving back towards 2%. And not having, and you've had a couple Fed governors just this week, or presidents of the regional Fed just this week, come out and talk about, no, there's still work to be done, and we shouldn't stop until well, they're not actually talking about this chart, but effectively they are, until we start getting things down towards 2%. We're not seeing it. We keep pushing.
Okay, thank you for that, Phil. So Jason, we have the audience projections and Phil's take on the matter, and You said that the market is pricing in something in the fall. What's your take on where interest rates are actually going to go?
Right. I think I agree with every single word that Phil said, so I'll try not to just restate them in my own less coherent way. Now, there is one way to bridge the view that Phil and I have. I'm expecting 2 more rate hikes this year, with the view that the market has, which is pricing in 1 rate cut this year, which is one of magnitude. If you told me that in December this year, rates moved by 50 basis points, I'd say that means they're probably 5.5. If you told me rates moved by 200 basis points, I would say that means they're definitely 3%. They're not raising rates by 2, 3, 4%, but you hit a financial crisis, something like that, they're going to cut them by that magnitude. Now, I think that rate cut is really quite unlikely, but in a very bad event, they could cut rates by a lot. There's no event that could cause them to raise rates by a lot. So there's a little bit of asymmetry here, and the market is pricing in part that asymmetry. Why do I think they're not going to cut rates? Exactly because of what Phil said in the chart you have in front of you. Core inflation has been in the 4 to 5% range for 2 years now. There are lots of different ways of measuring core inflation, by the way, or underlying inflation. There's different things that different people argue you can add and subtract. No matter which addition and subtraction you do, you get a number in the pretty much 4 to 5% range. You can also look at wage growth. Wage growth is at about 5.5% rate. Different measures show different things. That tends to run about 1% above inflation because productivity makes up some of the difference. And so wage growth is also consistent with inflation in the 4 to 5% range. Why might wage growth slow? Well, with an unemployment rate of about 3.5%, job openings continuing to be well above the total number of unemployed, workers continuing to quit to find other jobs at unusually high rates, it would be surprising to see a very big slowdown in wage growth. Without a big slowdown in wage growth, it would be surprising to see a big slowdown in inflation. Now, anything's possible, and I sometimes hear people talking about soft landing scenarios. But when I hear their soft landing scenarios where the economy keeps growing and inflation just magically comes down, they all involve lots of different things happening at once in some perfect type of way. There might be a 1 in 6 chance the stars align, you get a soft landing where inflation comes down without any pain, but I don't think that's the most probable here. And I think the Fed really sees it that way. If they see a month of 50,000 jobs, they are not going to panic. In fact, they are going to say 50,000 jobs is what we were hoping to get. If they see a month of minus 50,000 jobs, they are going to say to themselves, you know what? This is a bit lower than we wanted, but the data is noisy and volatile. There's still a lot of inflation. Let's give it another month or two. I think they would need to see 3 months in a row of job losses plus 3 months in a row of much slower core inflation before they even had a conversation about whether or not they should cut rates. And that's why I think a rate cut this year, absent a dramatic event, is pretty unlikely. And instead, the stubbornness of inflation is going to force their hand 1 or 2 more times.
So if I can jump in here, Jason, you made the point that we've had a very, very strong employment situation. As we noted, these were the Fed's 2 mandates, right? Full employment, we've clearly got that from this graph, and then stable prices, which we clearly didn't have from the other graph. You talked about the Fed looking at potentially falls in employment. Do you think that they have a target sort of natural rate of unemployment? I mean, the sort of classic thing, if we're thinking Phillips curve, I don't know where you are on this, but it was if you push down below this natural rate, you will necessarily get inflation. And you described the mechanism by which this might work. Is that I think the story we would often tell was you have frictional unemployment, other things, you start pushing too low, and then the only way you're going to get a worker is that you start giving raises to your competing businesses, workers to flip on over, and overall wage levels go up. So I guess my two questions on this would be, one, do you have a natural rate in mind? And two, what do you think the Fed thinks about natural rates at this point?
Yeah, so great question. The Fed, in their summary of economic projections, the members of the FOMC write down their forecasts. They have, at their median forecast, a 4.0% long-run unemployment rate. That has generally been interpreted as their estimate of the natural rate, because they think in the long run inflation is stable at 2. That's also in their projections. So they appear to think the natural rate is 4.0. I would say I agree with that. I would just put a huge error band on it, because I think there is some natural rate out there. It's just changing a lot, and we don't know what it is. I think much more useful, and I think they think this way too, is not to just look at the unemployment rate in isolation, but to look at 3 variables. I mean, you want to look at 300, but the 3 most important are the unemployment rate, the number of job openings, and the number of workers who are quitting. And quitting mostly means quitting to another job. If I had to pick, I would take the ratio of job openings to unemployment. That, prior to the pandemic, there was 1.2, and I think the labor market was pretty tight in 2019. It got all the way up to 2 job openings for every unemployed. It's now come back down to 1.6. And so I think the Fed's hope is that the labor market cools, but it cools not by the unemployment rate rising, but instead by job openings falling. That is what we've seen over the last, nearly a year. So there has been a little bit of cooling in the labor market, just with job openings coming down. But, I think that job openings at 1.6, even if they keep falling, even if they fall all the way to 1.2 before they were before the pandemic, is not enough to get inflation to 2.0. And by the way, that's my last point I want to make very clearly. I think it is likely inflation is going to fall. I think it's going to fall into the 3s. But the Fed's goal is 2. And if inflation falls to 3.5, that I really don't think that's going to be good enough for them.
What do you think, if you've sort of heard the kind of statements that Fed governors and members of the FOMC have been making, what would be a signal which is, okay, we've done our job on inflation? Does it have to be 2? Is it 3.5? What would they see?
All your questions are really hard, Phil. There's nothing from their statements that you could get an answer to that question. They reiterate the target, which is 2. They say they don't want to change the target. So it sounds like they're saying 2. I think if we get inflation to 2.9, they're going to feel fine about it. Maybe they'll change the target to be a range like 1 to 3, 1.5 to 3. Maybe they would say, you know what, inflation is still above our target, but we're not going to try to cause a recession to get rid of this inflation. We're going to do something called opportunistic disinflation. We're just going to wait for the next time we have lucky break, and that will take inflation down. So I think they're going to have to actively disinflate the economy by raising rates and the like to get it below 3. I think they're happy to let luck or drift take us from 2.9 to 2, and they don't care how long it is. Now, what I just said is my guessing what they're thinking. They haven't said anything like that. They haven't wanted to tip their hand at all, because if they do, they're afraid it will unanchor expectations and make their job that much harder.
Sorry, can you go in? Because I think this is an absolutely key point. Expectations. First, what is the role of expectations? Why do we care about them? And how do you think they're being formed? How long? So please, let's jump in on that.
So in theory, the main models that economists work with say inflation equals expected inflation plus something on top of that if the economy is tight, plus something on top of that if there's a bad supply shock. But the whole equation centers around expected inflation. Now, there's lots of different expectations measures, businesses, households, financial markets, economic forecasters. But the important distinction right now, at least, is between long-run expectations, what you say inflation will be 5 or 10 years from now, where everyone is basically saying something like 2%. They believe the Fed. They take it at its word. They think it's credible. And what do you think inflation is going to be over the next year? Here, the expectations are a lot higher. There may be something like 4%. And so, the Fed is trying to keep at least those long-run expectations at 2. They want people to believe them. And if they believe them, they think that will, in a self-fulfilling way, make it easier to control inflation. If you're a business and you think everyone else is going to raise prices by 2%, maybe you'll raise it by 2. You think everyone's going to raise it by 4, maybe you'll raise them by 4. Same things for workers. And so, that's why they would love to keep at least long-run expected inflation low, to keep the self-fulfilling inertial part of the wage price process low as well.
I think that's very, very well put. And the thing I would add on this is, I think this is why there's urgency for the Fed. One might well pose the question, why don't we wait and see? You do some rate hikes, and I think the reason there's an urgency where you don't just wait and see while you keep hiking rates and you're not at all happy with the core inflation hanging out at 4.5% is because there's that, for the reasons you just said, there's that concern, which is we don't know exactly how people form those expectations. For the moment, they're largely believing the Fed. They largely think 2%. But how many years can you go with inflation between 4 and 5% and still think that the long-run average is 2? And the worry is you leave it sitting there. At some point, people are going to say, you know what, I think it's 4.5, because that's just been my experience now for years. So because I think this is often a question, which is, and I think you've had some advocates, maybe call them doves, where it's like, hold on, stop raising rates. Let's just see what happens. And I think part of the argument for that, and what we put up on the graph here, is the green line is the normal Fed funds rate. We do our own version here of subtract off one of those core inflation measures to see what it is in real terms, where it looks a lot less dramatic. You're welcome to criticize that, Jason, if you like, because the choice of what you subtract off is important on this. But the point is, we've had a fairly dramatic increase. We went from 0 to near 5, and now we're thinking that 25 to 50 basis points more beyond that. The other question here, which I think makes this whole thing really hard, is when did we expect that stuff to kick in? So note that all starts in about March of last year. So we're about 14, 15 months into this. Well, a fairly conventional thing. I think Raph Bostic of the Atlanta Fed was so bold as to be explicit on this point, to give us a rule of thumb of 18 months. When we say long and variable lags, that gap between when it is that the Fed acts and when we really see the full impact of the economy, that we should really just be starting to see the impact of this stuff. So actually, I'd be very curious on your take, because of course, people who are out there trying to take out mortgages would say, wait, we've seen that impact. We've seen that right now. How do you think about that, Jason?
Yeah. On your first point, and that was the problem with Volcker. Volcker basically said, hey, inflation's going to come down. People said they've been saying that for a decade. Why should we believe you? And he said, look, because I'm willing to raise the unemployment rate to 10%. It's not an actual transcript of a speech, but it's the subtext of what he did. I do not think that needs to happen this time, because if they say 2%, people are more likely to believe them. Now, I don't think they'll believe them at a 3.5% unemployment rate, but I certainly don't think it needs to get to 10% to convince them. But the longer you wait, the slower you go, the more you're back in a situation where the only way to reset it will be something terrible, like what Paul Volcker had to do with the 10% rate. In terms of something like mortgage rates, the good news is the vast bulk of the change in mortgage rates has already happened. And they're probably already pricing in, maybe not fully what's going to happen going forward. So I think there's a little bit more risk of them going up than them going down in the future. But I think at this point, we're talking about mortgage rates moving by a half point in one direction or the other, not the multiple percentage points they moved before. And then, in terms of the lag length, sorry, Phil, I didn't get to that point you made, which was your actual question. I think the lags for output growth are more like 9 months. I think
Oh.
we have seen most of the output effect. Now, the level takes longer, but you picture sort of the biggest growth effect is after something like that. I think for inflation, it's a little bit longer, but the tightening we saw in monetary policy happened before the Fed even really raised rates very much, because just in expectation of it, mortgage rates went up, everything else tightened. And so I think it's basically been a year since the de facto tightening happened. And so much of it has worked its way through the system. The piece that hasn't is whatever the banking turmoil is going to do. And I think there's some uncertainty around how big that will be. I tend to think not huge, frankly, but it'll be something.
So
Phil, last word on that before we move on?
Yeah, so the last thing I wanted to take on this, and we can get to banking turmoil next, is, and this is something that I think Jason was getting at, as we're thinking whether it's 9 months or 18 months and whether it's mortgages, what is the transmission mechanism? We've got one last piece of data here, which I find very intriguing. This is the Chicago Fed putting this out, this financial conditions index, which is supposed to indicate that it's looking at very few people or businesses are borrowing at the Fed funds rate. And so this is looking at the broader range of rates at which someone might borrow. They've got this indexed so that above zero is supposed to be tight and below zero is supposed to be loose. And the story this tells is you actually had tight right as the pandemic hit. There were some extraordinary measures, a bit buildup of the Fed balance sheet, for example, that made things quite loose. We saw a tightening, but never quite getting to tight. And then actually that tightening seemed to stop just under a year ago. Jason, do you buy this? And this is presumably saying there's a gap here. And it's also true, by the way, if we look at longer bonds, their rates are not climbing in parallel with the Fed funds rate. So what I guess is a broad question about, you seem to say with 9 months that you think that transmission mechanism works pretty well. The Fed does stuff and it moves on to the economy. Does this cast any doubt on that?
Well, we started out with our discussion in this discussion today with GDP.
Yeah.
One of the components of GDP is residential investment, home building, and that turned sharply negative in the second half of last year and was still somewhat negative in the first quarter of this year. And I think that is where we have seen monetary policy working. So I think monetary policy has been slowing the economy. It's just the damage it's done to housing part of the economy has been outweighed by the increase in consumers, all subject to the caveat that all of this is poorly measured. But in terms of financial conditions, there's different measures. This is the Chicago Fed. That's one of the great ones. I look at it regularly. Goldman Sachs also produces one that I look at regularly as well. That one shows there is some tightness in financial conditions. It just hasn't tightened a lot in the last year. But I think all of them make the same point that people keep saying the Fed's raised rates. How long will it take to act? Well, almost everything that happened by, in the measure we're looking at here, by June of 2022. And since then, it's just been the Fed following through on what was expected. And that follow through doesn't actually have an economic impact. And the last thing I'd say is if you look since the day before, the problems emerged at Silicon Valley Bank, financial conditions measured in markets have actually eased. The stock market's up, mortgage rates are down, the dollar is weaker, which helps exporters. And so we've had some contraction in credit conditions for banks, but anyone borrowing in the bond market or borrowing for a home mortgage, they're paying lower rates now than they were before the banking turmoil emerged.
Okay, well, I think that's a good point to end that section on. And then moving on to the third section, where we've sort of left it open, and Jason has alluded to some potential shocks. And the one massive shock that hasn't been named so far is what is going on with the U.S. debt ceiling negotiation. Now, Jason, I've seen you've talked about this already in the media. I was wondering if you could give us your thoughts on how this might unfold over the next, few days, really.
Yeah, could be the next few days. It could be the next few hours. I think we don't know. My expectation is that it gets resolved. I think it is very, very likely that it will get resolved. There'll be some form of deal with discretionary spending caps, probably some other things. and an extension of the debt limit probably past the 2014 election. There's some risk around that the talks between the White House and House Republicans could fall apart. There's some risk that those two parties will reach a deal, but there won't be the votes to pass that deal. So I think there's still some chance that we go past the X date, which could be when the government doesn't have enough money to pay its bills, which could be as soon as June 1st, but there might be at least a tiny, tiny little bit of wiggle room there. We just don't know. Frankly, we'd rather not know. But, if we go past it, I think that's a problem, and that is a downside risk to everything we've been talking about here. But, and my hope is my optimism is not disproven 2 hours from now when there's an announcement that, talks have broken off. But even then, we know that talks can break off and talks can go back on again.
Yep, thank you for that, Jason. So, Phil, we've talked about banking shocks, debt ceiling. Do you see any other external factors affecting the U.S. economy over the next couple of quarters that we should be looking at?
Well, I'm a trade guy fundamentally, so I'm always inclined to look at trade. And actually, if we go to the next slide, I think we'll have something on this, which is one thing I would note is that often when you're thinking about economies and how they might go into a recession or come out of a recession, there's one of the things that factors in is if a country goes into a recession on its own, it might be able to work its way out of the sort of bad animal spirits by having its neighbors buy up a bunch of its goods, help get the economy revived. I think one of the real concerns here is what's going on in the rest of the world. That this is not, U.S. inflation getting out of hand. Actually, for those who were peeking at the green on that earlier graph, Europe has its inflation as well. The EU or the Euro area, the UK, and so you're getting this simultaneous rate rise where everyone's doing this in sync. And so I think that actually poses an additional risk is that these things get pulled down together. What you see here is that actually trade after its initial dip has been pretty strong. This is the U.S. imports in blue with our forecast at the end in the gray area. The imports have been weakening a bit in the last year, somewhat. Depends a lot if you look at certain areas like consumer goods. But you see that exports actually have been doing okay. And as Jason said, this is one of the things that drives the economy when you get exchange rates weakening and people can sell more. The problem is it doesn't work globally if everybody is weakening their exchange rates and trying to sell more because they can't all weaken exchange rates against each other. Those have to balance out. So that's one of my concerns. We got some numbers out of Germany recently that said there was a slowdown. So one of the things that worries me as we think about the potential depth of a slowdown is if it is synchronized around the world, that makes it harder to get out of.
Building on that, Jason, I know we've been focused pretty closely on the U.S. economy, and Phil's sort of taken us outside a little bit. Are there any external factors outside the U.S. that you're looking at sort of in the same vein as those that Phil just mentioned?
Again, Phil and I really see all these issues eye to eye. So there's not going to be much of a debate for all of you. But yeah, obviously the two biggest parts of the global economy outside the United States are Europe and China. Europe faces an additional challenge on top of the United States in the form of, the Ukraine war and the shock that had on electricity there. But now it is facing much higher core inflation than the United States. It's starting with lower interest rates than the United States. And so I think there might be a more protracted monetary struggle with inflation, higher interest rates, and the like in Europe. What that means is possibly a harder landing in Europe than we might experience in the United States. It would be the scenario I just said, consistent with somewhat of a weakening for the dollar, boosting our exports. And then China, I think the Chinese government has become much more growth oriented than it was 6 months ago, not just in terms of lifting the COVID lockdowns and the like, but just generally in its overall macro and even structural policy stance. And so I think that will be more of a driver upside driver. And China's, by the way, one of the few major economies that's not struggling with inflation. So it really has room in a way that some other economies don't.
Okay, turning to back domestically within the U.S. Phil, I was wondering if you could talk about Jason mentioned this a little bit earlier, government transfers, fiscal policy. How do you see this impacting the outlook for a recession in the U.S. or economic growth, as it were?
Well, I think it poses a question. I think you could call this the Jason was right slide, because he made the point earlier that a lot of what we had seen in consumption matched up very well with large fiscal transfers. And so what you see in this graph is that the top line is real personal income, but the sort of line, seafoam, I guess it is, green line down below is real government transfers. And what we saw coming out of the pandemic were some really dramatic measures to exercise fiscal policy, put in this case literally, well, not literally pockets, but put money in people's bank accounts, literally, pockets figuratively, but to get money out there, and that drove things. And I think then the thing that's sort of striking as we're trying to piece together where we're going is you look, and after the spring of 21, things calmed down a lot. That all of these sort of crazy spikes that we had in the first half of the graph kind of become fairly flat lines, with savings going down, which Jason also mentioned. I think there's a real question here. I think it's exceedingly unlikely that we're going to get more fiscal stimulus. I think one of the big questions is what Jason raised, which is coming out of the debt limit things, are we going to see, say, a bigger contraction on this? There's only so much one can do in spending, but does fiscal policy then start to come into play, and in a way that sort of does maybe some of the Fed's work for it?
Okay. Jason, last word on that topic before we move on to the question that we're going to grapple with for the end of this presentation.
I'd almost rather leave more time for that question, if that's okay.
Okay, excellent. So before we get to that question, we're going to pose it to the audience. So our next full question is, are we heading for a recession? No, would be a very blunt, simple response. Yes, shallow and brief. The audience is allowed to define to themselves what shallow and brief constitutes. Maybe Jason and Phil will explain in a little bit more detail. Yes, deep but brief, shallow and prolonged, or deep and prolonged. So the results are coming in, and yes, shallow and prolonged and shallow and brief seem to be the two most popular answers, sort of neck and neck at around 40%, although shallow and prolonged is now gaining. There's about half the answers. So, Phil, we'll start with you. How would you answer this question?
We have a wise audience. I'm with I think shallow and prolonged, although I might define shallow. I think it's going to be a very notable recession. It's not going to be one of those, yeah, it was in the numbers and ex post we classify it this way. I think it's something one is going to note. It's going to be a little while before it gets here. And I think we've built the case as to why, as we've talked about this, which is the one thing I will add in on this is we've sort of talked about I think it's monetary policy driving things and what's happening in the rest of the world. Both of those are worrisome. The thing that I think is important is that if you buy Jason's argument that the lag is only 9 months between sort of monetary policy and its real impact, this is less worrisome. If you buy Ralph Bostic and think it's 18 months, it's more worrisome. The question is, do we have a good model? And let me explain why I think models are important. You know, when you decide how hard to press the brakes on your car, you have a model of what this is going to do. You know that if you press a certain thing, then your car will stop in, 50 feet, or depending on what speed you're going, that kind of thing. The Fed is facing the same kind of problem, except all of a sudden the car is not behaving the way they expected it would behave. So you don't know. Maybe you need to slam the brakes really hard to stop in this distance, or you're not sure. You take precautions. I think that's much more likely to make the Fed overdo it. I buy just what Jason's been saying, where you want to see that core inflation get down, 2.9%, somewhere in there. The worry is if the lags are a little longer and you wait until you actually hit that point, you may have baked in something that takes more of a slowdown in there. And so that's why I would argue for a recession and probably deeper significantly deeper than we would have had if we actually understood better how the controls were working.
Jason, same question to you. What are you expecting?
So on a 9-month horizon, I think recession risks are elevated, but they're not incredibly high because household balances are household incomes are rising, which will help sustain consumption. The housing sector is stabilizing. I think we'll get some tailwinds from the weakening in the dollar and the like. I'm not incredibly confident in that. But what I think is if we don't get a recession in the next 9 months or so, inflation will be above 3.5%. The Fed will have to do another round of rate hikes, and they're basically going to ensure that there's a recession at some point. So my recession odds for the next year and a half would be about 2/3. And just to put that in context, normally for a given year and a half, the odds of a recession sort of randomly are about 20%. So that's way above what it normally would be. And it's basically that at some point, I think the Fed will kill the expansion. I think it just may not do it super quickly.
Okay. Just 2 or 3 minutes here before we wrap up. Any more questions from the audience? Phil, one question for you. If your sort of shallow and prolonged thesis is correct, what does that shave off of GDP and how long does it last, do you think?
Yeah, this will be a very satisfying answer. I don't follow the models as closely as Jason does. He quantifies far better than I do. I guess the version I think how long does it last? That is what worries me a bit, because then it's sort of how do we pull out of this? And I think I'm a little more pessimistic in terms of, I think, longer lags. So the scenario I'm thinking about, the time frame that Jason said, the next 6 to 9 months, maybe not quite so bad. I see the Fed having to overdo it. Then we get into a slump, and then the question is, what pulls us out? 2 candidates are the rest of the world's doing really well and they pull us out. That seems unlikely. Or the Fed I'll do more than 2. Or the Fed rides to the rescue, and that has a quick impact. I don't think the impact is quick. Or that we get sort of a fiscal measure put in there that sort of counterbalances. That seems unlikely in the current scenario. So that I don't have a precise number, but that is what leads me towards prolonged, where I'm talking about several quarters at least.
Okay.
Yeah.
Go ahead, Jason. Okay, yeah. So, well, we're just about at time. Any last words from you, Jason, before we wrap this up?
Just thanks for this. That's a great discussion.
Okay. Well, thank you for joining us. So I think we'll wrap it up here, unless Phil has any other last remarks that he'd like to make.
No, shocking levels of agreement on this one, but
yes.
I very appreciate Jason's insights.
All right. Well, thank you, Phil, and thank you, Jason. That was a very interesting conversation, and thank you to everyone who attended today's webinar. We'll email the slides and the recording out tomorrow morning. This will be followed by a short feedback survey that we hope you will answer, because that will help us make these better going forward. And thank you again, and have a great day, everyone.